Okay, welcome back to lesson 2.3, and this one is all about determining the intrinsic value using the internal rate of return, or known as the IRR. Personally, this is one of my favorite parts of this entire course, simply because I really think this is the meat and potatoes of what you are here to learn about, and that's coming up with what you think the value or the expected return that you'd get purchasing a stock at whatever market price it might be trading at. So let me start off by talking about what you've already learned with the net present value. So I'm going to pull up this equation that Stig was using where you're calculating the net present value by basically taking the price that you're paying for something, you're looking at all those future coupons, and then you're using a discount rate that you had selected in order to figure out what that net present value is. So in this lesson, you're going to go about it a little bit differently, and this is what I personally use whenever we were interviewing Bill Miller, who managed something like $70 billion, something huge number for Legg Mason. He was the chief investment officer for Legg Mason. He said that he uses IRR. I suspect people like Buffett and Munger and all those are well-versed on IRR as their primary means for determining the intrinsic value of a business. And what you're really doing is you're solving for the discount rate instead of using whatever discount rate you pluck out of thin air. And I know that that's probably somewhat confusing from the last set of modules of what discount rate should I use? Should I use 10%, 6%? And Stig was talking about the risk profile that's associated with those discount rates. But we're going to take this and we're just going to kind of flip it on its head, and we're going to make this really, really easy to understand. So as you're looking at this equation, the things that you got to think of that are the unknowns are really kind of the three variables. The three big variables are three things. So you got the price that you can pay to buy the asset, and then you've got the discount rate, and then you have the coupons, or what you expect the free cash flows to be into the future. Those are your three variables. And whenever you're in a private market, private equity, or let's say you had $1 million and you wanted to go buy an apartment complex, whenever you'd have that discussion with the person who'd be selling you that asset, a lot of the times the price is being discovered between that negotiation. There's no sign on the side of a large building like that that says $1 million. What happens is it's a discussion between the one person and both parties, and they kind of come to this determination that an appropriate discount rate might be 9%, 10%, or whatever. And before I get too confusing, let me take it back to what I'm trying to describe here, which is in that scenario of a private market, the price is not known. But whenever you get into public markets like the stock market, the price is known. You can log on to the internet, you can pull up the ticker for Ford or General Electric or IBM or any of those companies, and you will see a price that you can buy that equity for right now. And so let's take Apple, for example. You might be able to buy Apple for $150 a share right now, today, in the summer of 2017 when I'm recording this. So whenever you think about this equation that we have here on the screen, before we were treating the price as an unknown, like we didn't know what it was and we're trying to discover what an appropriate price would be. But in reality, we actually know what the price is if it's a publicly traded company on the stock market. So I would tell you, instead of treating that as if it's an unknown, let's treat it as if it is a known because we know what the number is. So if that's true and we know one of those three variables, let's talk about the other two variables. So you have free cash flow, what you expect the business to make into the future. That's clearly an unknown. We don't know what the business is going to make into the future, but we have models and ways to try to estimate what we think those free cash flows might look like moving into the future. So now that brings us to the last variable, which is the discount rate. So when we think about the discount rate, this is a really hard thing to determine. It's, you don't know how much these other assets all across the market. Now, and if you go to business school, what they have is this really complicated model called CAPM, where you're determining what the discount rate is based off of every other security in the entire market. And then it gets really confusing, and they're using various time frames, and they can basically manipulate what that discount rate would be. And I would tell you, my personal opinion, and I think a lot of billionaires that we've studied would tell you the same thing, that this whole CAPM model is a bunch of bunk. And the reason that they probably have that opinion is mostly because you can calculate what kind of discount rate you're going to get by fixing the other two variables in this equation. So we're going to fix the price because we know what that is. We know what we can go out in the market for today and get. And then we're going to figure out what we think the future cash flows might be. And then we're going to solve for the discount rate or the R in that equation. So that's my quick pitch on what we're going to be doing here. So once we solve the discount rate, what you need to be thinking in your head when I say discount rate is that's the return I can expect to get at the market price that the stock is currently trading for. So as that market price will change, let's say for Apple, it's $150 today. Well, when we solve for the discount rate and we let's say we find that it's 5%, you should expect a 5% return, assuming your free cash flows into the future are correct and you can buy it at that $150 price, you should get a 5% return. That's how you should think through the discount rate or the R when you're solving for this. So let me go ahead and start off with a really generic model. So I've got my Excel spreadsheet opened up here, and I've put in a couple future free cash flows here. So let's buy a business, okay? And let's say that the business will produce $100 of free cash flow next year or at the end of 17, 110 at the end of 18, 105 and 19. And you can see that these free cash flows are being estimated into the future. We don't know exactly what they are, but we think this is what the company is going to be able to make in free cash flow moving forward. So then the next question becomes, what is this business trading for on the open market? So again, like I described when we were talking about the equation, we know what this is for a public market. In a private market, you don't know what that is, and so you get into a lot of the NPV stuff that Stig was talking about in the earlier modules. But let's say that if we logged into Morningstar or any other stock analytics platform and we looked up for this company, and we can say that this company's ticker is company XYZ. And company XYZ is trading on the market for $900, okay? So if you want to buy one share of this company, it's going to be $900. So if we put negative 900 in here, let's assume that's the price we would pay if we would buy company XYZ today on the open market for $900. And these are what we expect company XYZ to make into the future. Now, any stock will go into perpetuity. Well, you hope that it'll go into perpetuity, but it's not a guarantee. But when you're valuing, you might value it into perpetuity, and you might take these free cash flows out to a much longer period of time. When we get into the advanced TIP model that I'm going to have here for you in just a couple minutes, you'll see that I do take that past 10 years. But let's just say we're going to value the business for the next 10 years, and then after that, the business dies. So if we're going to figure out what the discount rate or the return we would expect to get by buying these future free cash flows for $900, this is all we have to do. So we would type into our cell equals, and you type in IRR parentheses, and then what you're going to do is you're going to select all of these values to include the negative $900 that you purchased it for. Then you're going to carry that out. And then you're going to put a comma, and then you're going to close your parenthesis, and then you're going to hit enter. And then what you're going to see is that it returns a discount rate. It says 5%. And so what that's really telling you, this is how you need to think through this, is if I can buy this company for $900 today, because that's what it's trading for on the market, that is a fixed variable, 900. If I can buy that for $900 today, and these future free cash flows actually occur, these are exactly what happens in the future, which obviously isn't going to happen, but that's what you're estimating that's going to happen into the future. So if those two conditions are true, you can expect to get a 5% return on your investment. And that's the easiest way I can possibly describe this. So now, if that is how you understand your ownership of buying this business for that price and getting potentially that return, if this comes true, what you need to ask yourself next is, what other assets out there can I invest in that might give me a higher return than 5%? So let's say that you go to a 10-year treasury. Today, in the summer of 2017, the 10-year treasury is at about 2.2 or 2.3% return, which is lower than this 5% return that you would expect to get from this company, assuming this comes true. So now you can see you have an option. You have a choice between two different types of investments. You got one that's yielding 5%. You got another one that's yielding 2.2%. This one is obviously a lot more risk because it's a stock. And the other one is a lot lower risk because it's a government bond. But it's a lot lower of a return. It's half the return of what this might be yielding. So when you think through these different options and you study Buffett and Munger and all these brilliant billionaire investors, Buffett's constantly asked, how do you think through opportunity cost? And Buffett says, well, opportunity cost is simply my next best idea. And what he's getting at is, if I can buy this for 5%, and I don't think that there's a lot of risk in these actually not coming true, that's where you're talking about risk. Is the risk of these actually happening very high or very low? So if he thinks he has a high probability of these future cash flows happening, he would assess that his risk is low and that he's getting twice the return over a 10-year treasury. So that might be something that he should entertain, or an investment that he should maybe buy. Okay, that's how he thinks through risk. That's how he thinks through return. And that's how he thinks through opportunity cost of the next best idea that he has. So he's not only doing this between one company and the 10-year treasury, he's doing this between multiple companies, multiple risk profiles of all those companies and what they're able to earn into the future. And then he's making an assessment of whether he should conduct that purchase or not. So that's the generic example. So now we have built this intrinsic value calculator for you that you can download right off of the page that you're watching this video. You can adjust these inputs, and I've programmed this so that it actually charts everything, and I'm going to walk you through this model so you can easily understand how to do this for yourself. And I'm really excited about this because this is going to make your life really easy, and it's going to help you do quick assessments on various businesses. So let's go ahead and start at the top of the chart. So it says historical data. And what you're putting in here is the free cash flow of whatever business you want to input here. And the numbers that are in here right now are for Apple. And these are the free cash flows of Apple in the past 10 years. So if you go back and you would chart this is what their free cash flows look like up to 2016. And these are all annual data. And so if you were going to do this yourself, let me show you how you would do this. So here I am on Morningstar, and whenever you come to this page, you're going to type in the ticker for Apple, which is AAPL. You'd put that into the quote, and then you'd click on this tab called Key Ratios right here. And whenever you click on Key Ratios, it's going to give you the past 10 years of data for various things. And the thing that you're looking for is free cash flow, and you want the whole number and not the per share number. So go ahead and select, if you highlight all of this, and do not collect the data for the TTM. Skip that and just take the last 10 years of data. You're going to hit Command-C if you're on an Apple, Control-C if you're on any type of other computer. And then you're going to go back to our chart where we have the Excel data. And you're just going to hit Command-V or Control-V, and you're going to paste all that data. If you click on that, you got to click on that first cell and then paste it. You can't have all of it highlighted. Just click on the first cell and hit paste, and it'll all drop that information straight in there, and it'll automatically graph it for you so you can see what it looks like. So this is what's happened in the past. And as I just showed you, what the intrinsic value is based upon is what's going to happen in the future. So as we go down to this tab here, future data, you can see that we've got our past data here, the blue, already plotted. And what we have here is an array of potential outcomes of free cash flow into the future. And I have 3 lines. The top line is what I'm calling the upper band. The middle line is what I'm calling the most likely growth rate. And then the lower band is what I'm calling the lower band free cash flow growth rate. And whenever you're thinking about this, if a company is very high risk, these bands should be very wide. If you've got a company that's really stable, maybe the bands could be a little bit tighter. Okay, and you can adjust basically the width of those bands by coming over here and adjusting these inputs. If you haven't noticed, anything that's in yellow is your input. Everything else you can't adjust. So what we're going to do is I'm just going to widen this to show you what it looks like. So I'm going to type in 15% and hit enter, and you can see how the chart automatically adjusts, and it creates this rocket ship like curve that the free cash flow would grow at 15%. Let's say you thought the most likely course of action, or the most likely free cash flow for Apple, would be a 5% growth moving forward into the next 10 years. So there you go. There's your most likely. Then for your lower band, let's say that you think that it might also be a negative 15%. Okay. And it would look like that. So now you can see this array of potential outcomes that could potentially occur into the future. It's almost like a hurricane. If you ever seen an image of a hurricane tracker of all the different paths that it could take and then its most likely course, think of it exactly the same way. So now this is the part that I really like about this graph. And let me just make these probably a little bit more realistic. Let's say it could go 10. Let's say this is 2%. I'll just be pessimistic. And let's say the lower band could be negative 10%. So this is our array of what we think could potentially happen. Now, the next part is really important because what you're saying is, what's the probability of this happening versus the most likely versus the lower band? So when you're looking at this, you might be saying, I really have a lot of confidence in Apple's ability to continue to increase their free cash flow. And the reasons are, and this is really important, pay attention to how I'm phrasing this, the assets that they're creating today have an endurable competitive advantage to continue to be competitive into the next 5 to 10 years. So things like their iPhone, I think it's going to continue to dominate market share, and I think that the market size is, X, and I think that they're going to continue to have that. Therefore, I think that the likelihood of them being in the upper band opposed to the lower band is much higher probability. So let's say that we think that that's a 30% probability. Now, when I put 30% in there, you're going to notice that this automatically turned red. It said not valid. Upper band plus most likely plus lower band has to equal 100%. So what it's saying is you have to make sure all of these add up to 100%. So if I make that top one 30, this one now has to be 20%. Or I would have to adjust the middle one. Maybe I could have lowered my most likely to a lower number. But the important point is that these three numbers add up to 100%. And so if you think that the course of action is kind of skewed in this direction, you can adjust that with these likelihood of projections. And what we're doing is we're actually modeling and figuring out what the free cash flow might look like moving into the future, which is all these numbers down here. And what it's doing is it's taking a function of these most likely upper band, lower band in your projections. So if I put a lot of confidence in this middle band, okay, and let's say I just put 5% here and 5% here, what you're going to notice is that it automatically went and calculated these numbers down here for the projected free cash flow much more closely to this 2% growth rate than the negative 10 and the positive 10% growth rate. So this is important for you to think through this, because what you're doing, if you could draw a probability plot, like a bell curve here, what this likelihood of projection is allowing you to do is to not make the probability plot normally distributed. You could actually skew it to the left or to the right on your probability plot. Let's just say you thought that the chances of it going down would be very high. You could put this at 40% here. You could put this at 50%, and you could say there's only a 10% likelihood of the upper band occurring. And what you've done is you've just skewed your free cash flow down, much further down into this area. But you've done it through a logical sequence of how you're looking at this chart and how you're thinking through maybe the way that this will work. And so when you look at how this free cash flow would have gone, it starts out at $52 billion, and you can see it's going down, and then it starts coming up a little bit because it's averaging out all these potential outcomes. It's averaging all this stuff, and you can actually see that the projection actually would have come up and slightly up based on the way that you would have entered your likelihood of projection. Okay, so make sure that you enter your current year in here so it gives you accurate data as it's pumping this out. And then the final part is this. You're going to enter the number of shares outstanding, because all these numbers are for the whole company. This is the free cash flow of the entire business. So if you enter the number of shares outstanding today, for Apple it's 5,500 billion shares, and the current market price in a per share is around $150. And so based on those inputs and based on that free cash flow projection that we made up here, based on these numbers, okay, and it came up with this estimate of what the future free cash flows might look like, we have an expected return of 4% if we buy the company at $150. So I love this product. I personally use this product. I think it makes a lot of intuitive sense for me to think through how I invest. As this stock price changes, as we look at this stock price at $150, let's say that Apple goes up to $170. Now, what do we intuitively think should happen with our expected return if the price of the stock goes up to $170? And all those free cash flows remain the same, because we're assuming that the expectation in the future is going to be exactly the same. So if we hit enter, you're going to see that the price, well, it didn't change too much. Let's adjust it a little bit higher. Let's say it's what I can do from the time I record this, I can actually add that so that it has more decimal places and you could see the changes. But if I add 190 and I hit enter, now what you're going to see is that it's down to 3%. So the higher that this goes, let's say it's $250 and the free cash flows remain the same. Well, the expected return should go down. And it did. It went down to 1%. So you can see as the prices go higher and higher and your expectation for free cash flow into the future remains the same, you should expect the return on that investment to go down. And that's really important. This is an interesting point. So about 9 months ago, I wrote an article in Forbes about Apple, and it was currently trading at about $100 a share. And when you hit enter, you can see that when it was $100 a share, the expected return was 8%. The S&P 500 index was priced at about a 3 to a 3.5% return during that time. So Apple was significantly undervalued because you could have expected an 8% return. Assuming these free cash flows are correct, you would have expected an 8% return at that price. So you can see how when people say, well, it's under its intrinsic value, well, that's how we're thinking about it. We're like, hey, I can get 8% instead of the 3% in the S&P 500, so this is undervalued. That's how I think through things. You'll often hear people say things like, I think the stock is worth $150 a share. And they never talk about the discount rate or what kind of return they expect to get at $150 a share, which to me doesn't even make any kind of sense. So if somebody says, oh, I think that Apple's worth $150 a share, and my immediate reply to somebody that would say something like that would be, oh, do you expect to get a 4% return at that price? Because then I'm able to marry up what they think their future cash flows would be with the price that they're saying that they think it's worth. And that's how I have to think through this, because if I don't talk about discount rate attached to the market price, because all this stuff is tethered, it never makes any kind of sense. So I hope you guys really enjoy this tool. One final thing that I want to talk about, because I had briefly mentioned it in the previous, when we were talking about the generic example, is the perpetuity piece. On the S&P 500, the average life expectancy for a business to be on the S&P 500 is 15 years. This used to be much longer if you went decades back, but now today it's only about 15 years for a business to remain in the S&P 500. As a result of that, my model covers 15 years of information past the 10 years that it's displaying here. And what happens after the 10-year mark on this calculator that you're using, what happens is this number becomes fixed. Whatever this number ends up being in 2026, and let me just show you it going down. So like, let's say that we have 100% confidence that the lower band is what's going to happen here. And whenever we put 100% confidence, you can see that this number is going down. It starts off at 52 presently, and it goes clear down to 18 billion into the future. And you can see how our expected return went to negative 1% at $150. So let's change this to maybe $50, and now we're getting a 9% return based on those projections, okay? So you can see how all this is playing out. But what happens is into the next 5 years, past this 10-year mark, so if I could come over here and I could project out another 5 years, what the model's doing is it's fixing this number. It's saying 18, 18, 18 for 5 years. Then after those 5 years, it's actually decreasing at 5% out to 75 years. And then what's happening is it's adding up all those future cash flows out to 75 years and back. If you're concerned about using that model, I think it's a very conservative estimate. I personally don't like to estimate things especially past 10 years, because you have no idea what's going to happen with some of these businesses. I think that using anything higher than that or more aggressive than that is probably being somewhat misled, and you're not thinking through the potential difficulties that some of these businesses can incur past 10 years from now, because there's way too many things that can happen to some of these businesses that are unexpected. So I would tell you to think very conservatively. We talk about some of this stuff about future cash flows, arrays into the third module, and kind of how to think about some of this stuff and how to marry up your competitive advantage in your qualitative assessments with some of these projections. So if you're wondering, how do I estimate some of these future projections more accurately, we talk a lot about that in the third module, and we give you a checklist in the third module on how to go through a lot of the competitive advantage type things in order to make a better assessment of where these future cash flows might go. So I really hope that this IRR discussion was useful. This is what I personally use to determine intrinsic value, and I hope you guys really enjoy using this little model.